it's going to go from whatever you bought it at. Let's say you bought it at 200 bucks, and it's just slowly going to race towards $1,000, at maturity, because you're going to get paid the principal back when it matures. All right, this slide just shows you a table with all the numbers in case you're interested in looking at them and seeing how the prices for all three bonds are going to converge closer and closer and closer towards $1,000. Here's another slide straight from your book that's going to show you, essentially the exact same thing. Okay, class, now we're really shifting gears into measuring yield. So what is the yield to maturity on the following bond? 10-year, 9% annual coupon, $1,000 par value, selling for $887. So the first thing I'll do in my mind is say, well, what do I have? What's given here? 10 years is my N. What is that 9% annual coupon? That 9% annual coupon tells me that I'm going to be paying a $90 payment, at least annual payment, right? The $1,000 par value is just my future value, and the selling for $887 would be negative $887 for my present value. So I've got for the 5 things. All I need to do in my time value money buttons would be to solve for I. This right here also shows you how to do it, using the equation. So either way you want to do that. Now, if like me you'd like to use your time value money buttons because it's quicker and easier, then right here shows you the inputs and the outputs. Okay, so this would have been a pretty easy problem. You put in 10 for N, negative 887 for present value, 90 for payment, 1,000 for future value. Compute I, and you get 10.91%. So what if we change the bond price to where it's a premium bond, right? And let's change that to negative 1,134.20 for present value, and then hit compute I. Notice that I now is going to go all the way down to 7%, and that should show you right there that if you raise the price, that means the interest rates went down, and whereas beforehand the interest rates were really high and the price was really low, right? There's that inverse relationship. Always remember that. Okay, so once again, let's go over the some major definitions. The current yield is that annual coupon payment divided by the current price. The capital gains yield is going to be your change in price over your beginning price. All right, and then the expected total return is your yield to maturity. Okay, so to get your yield to maturity, all you have to do is add your expected current yield plus your expected capital gains yield. Let's take a real quick example. Find the current yield and the capital gains yield for a 10%, for a 10-year, 9% annual coupon bond that sells for $887 and has a face value of $1,000, right? So, to find the annual coupon payment first, that's 9% times 1,000, so you put $90 in the numerator. $887 is going to be your price. That would go in the denominator, and you're going to get a current yield of 10.15%. Now, to get your capital gains yield, you could figure that out simply by rearranging the equation. Yield to maturity equals current yield plus capital gains yield. So if you find the yield to maturity, which we already found a couple slides ago, minus the current yield, which we found in the very last slide, you're going to find a capital gains yield of 0.76%. Now, you could have also figured this out by just taking the expected price 1 year from now and dividing it by the change in price by the beginning price. Okay, so those were a couple ways that you could measure yield. How could you go about assessing risk? Well, one of the things that we really need to talk about is price risk. And what is price risk? Price risk is just that you're worried that interest rates may go up, so your price might go down, right? So you have to be worried about what interest rates may do to prices. So which type of bond do you think would have more price risk, a 1-year or a 10-year bond? Well, right here you can see that the changes between a 1-year bond, it's not as big of a deal as the changes between a 10-year bond. So a 10-year bond is definitely going to be more sensitive to interest rate changes and hence has more price risk. Makes sense, and we've talked a couple of different reasons why long-term bonds can sometimes be riskier than short-term bonds, and one of those reasons is price risk. So once again, there's a few things I want to point out about price risk. 1, it's a change in price due to changes in interest rates. 2, long-term bonds have more price risk than short-term bonds. And three, low coupon rate bonds have more price risk than high coupon bonds. Now, we didn't mathematically talk about that in the last slide, but it is true, and you can obviously play around with your calculator and figure this out. You know, it could also be just pretty intuitively obvious, because if think about it, if you've got a bond's paying a high coupon, that's a pretty good thing, and so it's definitely not going to be as affected by any changes in interest rates, because it's more likely to still be a good bond since it's paying the high coupon rate. Those low coupon rates, though, are, you've got to be a little bit more nervous about them. Here you have a small figure graph here that illustrates price risk. And here's a very similar graph straight from your book, and it's showing pretty much the same thing, except instead of with a 10-year bond, you're looking at a 15-year bond. Now, one of the things you're going to notice here is that there's a lot more volatility with the 15-year bond as far as prices are concerned than there is with the 1-year bond. That volatility is a measure of risk, and you can see here that there is going to be more risk involved with a 15-year bond than with a 1-year bond, which looks very steady. At 10%, which is the market interest rates, at those 10% coupon rates, both of those bonds are going to be equal to 1,000, so that's that point where they're all both equal. However, if you change market interest rates one way or the other, you're going to notice a very big swing, and notice that that yellow line swings far more dramatically, and that's the main point here. And then you could also maybe notice that the coupons are going to that swing is going to be a little bit more aggressive with the lower coupon payments. Now, sort of on the flip side from price risk is reinvestment risk, and it's another type of interest rate risk. But with reinvestment rate risk, there's concern that if the interest rates fall, future cash flows will have to be reinvested at lower rates, hence reducing income. Now, what does that mean? Essentially, that means that if a bond matures and interest rates fall, I'm a little bit worried, because now I have to reinvest this money at a lower rate than what I had before. Right? So now I'm going to be making less income. So let's take an example here. Suppose you just won $500,000 playing the lottery. You intend to invest this money and live off the interest. You may have a couple options here depending on how you view reinvestment risks. So first, let's take a look at what are the main points of reinvestment risk. Remember, reinvestment rate risk is uncertainty concerning rates at which cash flows can be reinvested. Short-term bonds have more reinvestment risk than long-term bonds, and this obviously makes sense, right? Because they're going to mature sooner, so you have to worry about what are you going to do with that money. So for example, I have no real reinvestment rate risk with my 401k. I can't even touch that money till I'm later in my later years in life, right, in my 60s and whatnot. So, but if I've got some money that's about to mature right now, there's some reinvestment rate risk. What am I going to do with that money? Okay. Then high coupon rate bonds have more reinvestment rate risk than low coupon rate bonds. So both of these points are opposite of price risk. Why would high coupon rate bonds have more reinvestment rate risk? It's because I got a good deal going, but I'm worried that when I reinvest it, that I'm not going to have such a good deal. All right. So if you know that you've got a sweet deal lined up and you're making 10% on some CDs, and you've been seeing what interest rates have done, you're probably worried that you're not going to be able to get a CD for at 10%, and you're not going to get anything close to that, right? Okay, so let's take a look at our scenario with our $500,000 lottery win. Now, you've got two options here. You may invest either in a 10-year bond or a series of 10 one-year bonds. Both 10-year and 1-year bonds currently yield 10%. So if you choose the first strategy, the 1-year bond strategy, or I guess I should have said the second strategy, but if you're going to choose this 1-year bond strategy, after year 1, you reinvest, or sorry, you receive $50,000 in income and have $500,000 to reinvest. In other words, you're just taking the interest you get for that year. So if the 1 year rates fall to 3%, your annual income would fall to $15,000. Whereas if you take the 10-year bond strategy, you're going to lock in for this 10% interest rate over the whole period of time, and that $50,000 annual income, you're going to get that each year for 10 years, assuming that you don't have some strange protective covenant or anything in the bond such as making the bond callable. So it should be pretty obvious that with the 1-year bond strategies that you have less price risk, and with the 10-year bond strategy you have less reinvestment rate risk, right? So what is the conclusion when comparing price risk and reinvestment rate risk? If you look, price risk is going to be a concern with short-term, excuse me, I said that backwards, with long-term bonds, okay, and or low coupon bonds. Reinvestment rate risk is going to be a big concern with the short-term and or high coupon bonds. As long as you can remember those, this little graph right here kind of keeps it all together, then you'll be fine. And in fact, this is two of the first major points of something called Machiel's 5 theorems about bonds, and you won't learn about that until you take an investment class. But when you do and you hear about it, remember, oh yeah, that's right, in Finance 3020 we talked about price risk and reinvestment rate risk, and so this is theorems 1 and 2 pretty much of those 5 theorems. And also remember, you can't get out of risk, unless you find some kind of crazy arbitrage opportunity, which is a word you might not need to know just yet, but almost everything that you do in life is going to have some risk involved. Now, if you'd like to look at a couple of conceptual problems, you could look at problems number 22, 23, and 38 on your test guide, and that can give you some idea of what type of problems I might ask concerning price risk and reinvestment rate risk, and what the difference or sensitivities between short-term, long-term bonds are, and high coupon and low coupon bonds. Okay, so let's take a real quick look at semi-annual bonds. Now, the only difference here really is that we have gone from annual payments to semi-annual payments. Now, you can use your bond cheat sheet, or you can also look at how I've laid it out real quick right here. If you're dealing with years, you would multiply those by 2 to get the number of semi-annual periods. If you've got an interest rate, you're going to divide that by 2 to get the semi-annual periodic rate, okay, or the semi-annual yield to maturity. And if you've got an annual coupon, you would divide that by 2 to get your semi-annual payment. Okay, as long as you can remember that, and then you understand inputs. Now, the outputs would be the exact opposite as far as multiplication and division. And as long as you understand that, then we're good to go. So what's the value of a 10-year, 10% semi-annual coupon bond if R is 13%? Okay, make sure you multiply your years by 2 here. So you got 20 for N for semi-annual periods. Your I is going to be that 13% divided by 2, or 6.5% for semi-annual yield to maturity. Your payment is going to be 10% coupon rate times par, which is $100, but then divide that by 2. And then you get $50, and then remember that par stays the same. So you solve for present value, and you can get a price of $834.72. Now this slide is somewhat interesting. It's got a lot that looks like that's going on there from a math perspective, but it's a real simple question. Would you prefer to buy a 10-year 10% annual coupon bond, or a 10% or a 10-year 10% semi-annual coupon bond? Everything else being equal. And the answer is obviously semi-annual bond. Why? Because the semi-annual bond gets to compound for 2 periods instead of 1, and so you get a little bit extra with compounding interest, 10.25% instead of 10%. So obviously you would prefer that semi-annual coupon bond over a similar annual coupon bond. And that's a pretty nice conceptual question for the exam. If the proper price for this semi-annual bond is $1,000, what would be the proper price for the annual coupon bond? So with this problem, all you have to remember is that the semi-annual bond had that yield to maturity of 10.25%. So if you make your yield to maturity 10.25%, So use that EAR there for your yield to maturity. Okay, and then you keep everything else the same, right? It's 10-year bonds, so put in 10. Payment's going to be $100 because remember it's like a kind of a 10% coupon bond, and the future value is 1,000. So if you do all that and you solve for price, you're going to get a price of $984.80. And the reason this is happening is because you're kind of saying when you ask this question, what would happen if interest rates went up to 10.25%? Okay, it's a similar question because effectively that's what we're asking here. So you just change your yield to maturity and you solve the problem. Now, if that I would have been 10%, obviously the price would have gone to $1,000, right? And you can do that for fun. We've been proving that all day or throughout this whole lecture that if the yield to maturity and the coupon rate equal the same thing, then your present value and your future value will both be equal to par. Okay, now we're talking about something totally different where we're talking about yield to call. I put this slide in here just for those that are curious, but this is not something that you would be tested over. You can probably figure out what the inputs are here, though. I mean, it's a semi-annual bond. It's going to get called in 4 years, so 2 times 4 is 8 for N. If you look at your present value, that's going to be the price. So you're going to plug in $1,135.90, make it negative, right, for your present value. Your payment, it's a 10% coupon rate bond, so the annual payment's 100 divided by 2, you get 50. And then your future value. In this case, you actually have one rare situation where you're not going to have $1,000 as the future value because you're calling this in 4 years for $1,050. So make sure you make that change, and then you're going to just solve for your interest per year, which in this case is your yield to call, and that's where you get this 3.568% number. However, remember, this is a semi-annual yield to call, so you'd have to then multiply that by 2 to get your annual yield to call. All right, so once again, as it explains here, to get the annual yield to call, you're going to have to multiply this 3.568% times 2. That gives you 7.137%, and so that would be the rate that a broker would quote. You could also use the equation right there below to change that into the effective yield to call because of the compounding that's going on during that 1 year for 2 periods. Once again, you don't have to do this for this exam. I just wanted to expose you to a problem about yield to call. The only types of questions I'm going to ask are some basic definitional or conceptual questions. So here's another slide that just is asking you some more information if you want to think about yield to call questions. If you bought these callable bonds, would you be more likely to earn the yield to maturity or the yield to call? The coupon rate equals 10% compared to the yield to call, which is 7.137%. The firm could raise money by selling new bonds, which pays 7.137%. So in other words, think about this. You could replace the bonds that are paying $100 per year with bonds that are paying only $71.37 per year. If I was an investor, if I invested in these bonds, I would expect these bonds to be called. So it's simply just a matter of math. I mean, if the rates go down enough, the issuer is going to call a bond. So this brings up my final question about callable bonds. When is a call more likely to occur? In general, if a bond sells at a premium, then remember that with a bond selling premium, we pretty much know that the coupon rate is going to be above yield to maturity, right? In other words, interest rates have gone down, so that makes a call more likely. So expect to earn yield to call on premium bonds and the yield to maturity on par bonds and discount bonds. It's that simple, okay? If I ask you a conceptual question, it's probably going to come from what we're looking at here on slide 62. All right, let's also look at default risk. So we got a few slides here dealing with default risk. Really, the default risk is nothing more than the chance that a company is not going to be able to uphold their obligations, right? The company might default, go into bankruptcy. The biggest default of all time, does anybody know? Well, that would be Lehman Brothers, right? Lehman Brothers was our biggest bankruptcy of all time, and it pretty much came out of nowhere. So even some companies with really high credit ratings that can default. But usually we have some good credit ratings kind of help you measure what's the default risk of a company. For example, you'll notice that our bonds are going to be rated higher than say Greek bonds, right? Because we've all seen what everything that Greece has had to do. So some important things to remember about default risk. If there is a default, you're probably going to get less than what you were promised. Therefore, you're going to have a lower expected return for, say, corporate bonds or muni bonds than you would with treasury bonds, because you're pretty much guaranteed with treasury bonds. In fact, we often use the treasury bill for the risk-free rate. Okay. The default risk is also going to be influenced by the issuer's financial strength and the terms of the bond contract. Okay, so it depends on what those exact terms in that bond contract are as well. So let's go over the definitions of these different types of bonds, dealing with some different types of default risk. First are mortgage bonds. This is nothing more than just a bond secured by a mortgage on one or more assets, or you could say it's backed by a pool of mortgages on real estate such as a house, right? And you can get into mortgage-backed securities as well, which goes all the way back to the beginning of our lecture when we talked about Freddie Mac and Fannie Mae and Ginnie Mae. Okay. And then once again, a debenture is just a type of debt that's not going to be secured by any type of collateral or physical asset. And then with these subordinated debentures, remember, it goes back to that word subordinate. You're talking about bonds that somehow rank lower, right? So they're going to get paid off after more senior debt issues. And then finally, we get to some unique terms such as investment grade bonds and junk bonds. And one of the things I'd like to point out here is that investment grade bonds are anything that's based on, Standard & Poor's rankings, anything that's triple B, BBB, and then up all the way to AAA. Anything below that, like BB and, down into the C bonds, those are all going to be junk bonds, or what's known as speculative grade bonds or high yield bonds. And this is important because by law, a lot of, companies, or especially investment banks, are only allowed to invest in investment grade bonds. So once again, let's take a moment to talk about bond ratings, because I'll definitely ask a question or two on your exam about this. I talked just a second ago about Standard & Poor's or S&P, and you can see investment grade goes from AAA to triple B, and then junk bonds are going to be anything that's double B and below. Moody's has slightly different letters for their rankings, but they basically mean the exact same thing. The whole point here is that they're trying to tell you whether or not, there's a chance of a default, right? And there's only a couple of companies right now that have AAA ratings. And a few of those companies are, I believe, still Johnson & Johnson, ExxonMobil, and Microsoft. I know that they were the only 3 AAA rated companies in 2014, so now it's 2015. That's probably still pretty true. These ratings don't change that much over time. It was a big deal when the U.S. government actually got knocked down a peg from its AAA rating, and so that created some controversy and whatnot. But for the most part, you don't get too worried until you get down close to that BBB point if you're an investment bank, because you don't want it to become a junk bond and then have to sell or be forced to sell it because it goes into junk status. Now, there's two really cool sounding terms, rising stars and fallen angels, with bonds, and what they are is, they describe bonds that have had some kind of movement. So if you are, a speculative bond or junk bond, and then you somehow get a good rating and bump up into investment grade, you're called a rising star. But on the flip side, if you are an investment grade bond and you somehow get knocked down into junk status, then you're a fallen angel, right? And that would be that'd be pretty bad, right? So rising stars would be a good sign of your credit, and then falling angels would be a bad sign of the direction that your credit's moving in. And so, that's pretty much all I want you to know about bond ratings. I've got a couple questions on the test guide, problems number 27 and 28, that you might want to take a look at. Okay, so I just put this table in here just in case you're curious. This will show you some adjectives associated with the different bond ratings. These adjectives can be everything from like excellent, strong, satisfactory, weak to vulnerable right at the bottom. And this graph also, or table, shows you some interesting numbers that they're going to be looking at, such as cash flow and your debt leverage and your debt to your EBITDA, or earnings before interest, taxes, depreciation, and amortization. you obviously don't have to memorize anything from this slide. I just thought it was interesting. Now, Figure 7.4 is going to put the U.S. government bonds in the green. It's going to put corporate AAA bonds in blue, and then corporate BBB bonds in orange. And as you can see, since there's more risk associated with each step up here, that these bonds are going to get a higher yield depending on what time, for that specific year. And sometimes the spread between these is not that big of a deal, such as in the mid 90s, and then sometimes it can be very wide, like it was in 2009. Now, why would that be? Well, in 2009, remember, we just had the recession, so there was a flight to quality, and so a lot of people wanted to put their money with the U.S. government because they felt that was much safer than with corporations. Here, Figure 7.5 is going to show you the relationship between bond ratings and bond yields, and this is over a very small period of time following that recession that we just talked about, right? And I think the main point I want to make here is just with the yield spread, and you can see that over that 4-year period, the yield spread has opened up, especially towards the lower rated bonds there. So you're starting to get some more of spread there when you're getting towards those lower rated bonds. If you're interested in some more information, especially about corporate debt, I put table 7.5 in here. It's going to be a little hard to see, but obviously you can go and look at it in your book. Really what I found interesting about this is it goes all the way back to our talk at the beginning about the difference between debt and equity, but you will see that sometimes here bond prices and share prices will move in a similar pattern, or that one will actually anticipate the or predict the movement of the other. And so that's just a really neat little table to take a look at. I think you'll get a lot of interesting information out of that. So what are some factors that affect default risk and bond ratings? Okay, well, Moody's and S&P, they're going to have to take a look at certain specific numbers to figure out the default risk anyway. We don't know exactly what their equations look like and, what they take into consideration. But here are some things that we do know that they look at. They're going to look at the debt ratio and the current ratio and the times interest earned ratio. They're also going to look at some qualitative factors such as contract terms. Are we talking about secured debt versus unsecured debt, senior versus subordinated debt, guaranteed or sinking fund provisions, and also debt maturity. So they're going to take a look at all of this information, right, and deciding what to give a specific bond issuance as far as, a bond rating. And that doesn't mean that they don't look at anything else, right? There's all kinds of factors, and here are just a few miscellaneous qualitative factors. Are their earnings stable? What's the regulatory environment look like, and could that hurt them? Right now, in year 2015, we've been facing a lot of increased regulations from the last recession. So, is that messing with certain companies more than others? Potential antitrust or product liabilities. Do they have any kind of patents? Are there going to be any kind of lawsuits? Are there any pension liabilities? Like, obviously a lot of the big car manufacturing companies recently had to go through their issues, and still will probably, do this for a long time to come. This happens a lot with muni bonds too. You got a lot of cities that are dealing with pension issues right now. Chicago has a lot of pension issues that they need to get cleared up. So pension liabilities can be important. Potential labor problems will always, be an issue. Are they, is this company working well with its unions, or is it going into a lot of combative situations with the unions for that particular industry? All right, so this gets us into our last few slides. They're about bankruptcies, and this slide is really important. I'll definitely consider asking an exam question from this slide. So there are really two main chapters of the Federal Bankruptcy Act. There's Chapter 11, which deals with reorganization, and Chapter 7, which deals with liquidation. Now, following the recession, we had several companies that actually decided to reorganize. And a lot of times that doesn't mean that company is going to go away. That just means that that company has to get a few things together so that it can come back and be productive and profitable down the road. Chapter 7 though means liquidation, and that means that company is pretty much going bye-bye. So in some cases, some companies are worth more alive than dead, and some companies are worth more dead than alive. So let's talk a little bit about Chapter 11 bankruptcy specifically. This is for companies that can't meet their obligations. This is basically done just to keep creditors from foreclosing on their specific assets, and really gives them a window there, usually around 120 days or so, to file a reorganization plan. And they'll appoint somebody like a trustee or supervisor that's going to be in charge of this reorganization, but management is really going to stay in control. If this reorganization plan doesn't show that it's worth more to keep this company going, then a judge can come in and say, you guys are going to have to liquidate. And so sometimes a Chapter 11 can turn into a Chapter 7. All right, so let's say we do have to go to liquidation. Who gets priority over who else? It's important to remember that creditors usually get to go to the front of the line, and that common shareholders usually go to the back. But there's a lot of kind of folks that line up in between. So number one is going to be your secured creditors from sales of secured assets. Now, what you're going to next notice is there's going to be a lot of people that might be involved before you get down to the unsecured creditors. The trustees' costs will be in there. Wages, subject to certain types of limits. Taxes could be in there as well. Unfunded pension liabilities, and then you're going to get down to these unsecured creditors. So being an unsecured creditor is not like you're right behind that secured creditor. There could be some issues there where the secured creditors get fully paid, and there's nothing left over for the unsecured creditors. After them, you get to preferred stock holders, and then last are those common shareholders. So there's two real important points here about reorganization. One, in an event that we do go to liquidation, unsecured creditors are generally not going to get anything. So this is going to make them really want to participate in the reorganization process. In other words, they may actually decide that they'll take a little bit less if they can keep the company going, because that's the only way they're going to get anything. So various groups of creditors are going to vote on this reorganization plan, and if both the majority of the creditors and the judge approve, then the company is going to get to come away from bankruptcy with lower debts, reduced interest charges, and a chance for success. So that's really how it works. You may remember that unfunded pension liabilities were right in front of them, so you might have the unions involved as well, and they'll be willing to take a little bit less too, because they don't want this company to completely dissolve. So but this is a reorganization is an important process that has helped some companies keep going on and adjust for some of the things that maybe they didn't see happening down the road, such as people living to be as old as we live to be today. Okay, now hopefully this has helped giving you a lot of information and a real thorough understanding of bonds. I would focus most of my attention on this lecture for your next exam on bonds, and also on the test guide. If you have any questions, please let me know. Thank you. This concludes lecture 3.2 on bonds and their value.